Well, do you belong to Gen Z and are looking to build a perfect portfolio? Well, don't make the mistake of comparing yourself to the previous generations. You may feel that your starting salary is way better than someone who started out, say, in the 1960s. And why do I say that? Well, that's because back then the prices, background, socio-political situation, investment avenues and job scenario, everything was completely different from what it is today. Even if you look at the salary difference, 100 rupees in the 1960s is equals to 8,858 rupees in 2022, assuming an inflation rate of 7.5%. So using the same old scale to measure success or efficiency in investing would simply be erroneous. That's why Gen Z should look at building their portfolio in a manner that is a bit different from how well-established investors of the past would have. So the question is, how should Gen Z go about building the perfect investment portfolio? Well, if you want to know the answer to that, keep watching this video. Before I go ahead and reveal the answer to you, you know what you gotta do. Well, hit the like button and share this video, and of course, subscribe to the Money Control YouTube channel. Also, don't forget to hit the bell icon. Now, coming to what Zoomers should do to construct the perfect portfolio. Future is fine, but don't forget to live in the present. First and foremost, don't get so engrossed in planning for the future that you lose sight of the now. The importance of having an emergency fund in place cannot be undermined. Your emergency fund should be enough to cover your lifestyle for the next 6 months at the minimum, and having it liquid is equally important. Fixed deposits or liquid funds are the ideal way to build your emergency fund. Be truly free by being debt-free. If you have dues to be paid off, make that one of your first priorities. If you let that debt pile up alongside your wealth building won't be as meaningful. Letting your debt accumulate will only result in you paying a higher amount eventually. Now, it's never too early to think about retirement. Don't let your peers fool you into thinking that retirement planning is an after 40 job. The sooner you start, the more comfortable your retirement will be. Moreover, who's stopping you from planning for an early retirement? We've heard of plenty of people wanting to retire to the hills by the time they are 40, haven't we? And if you're one of them, well, the time to plan is now. Categorize and prioritize. Random investments may not prove effective in covering all your goals, so it always helps to categorize your goals into 3 buckets. Short term, which is less than 10 years, mid term, which is anywhere between 10 to 20 years, and long term, which is in excess of 20 years. Now prioritize your goals within these 3 categories so that you can find the right investment for each. Consistency. If you belong to Gen Z, you will agree that the brilliance of systematic investment plans or SIPs lies in its sheer simplicity. When started early and empowered by consistent investments, SIPs can prove to be a force multiplier in building wealth. But without consistent investments, you may miss out much of the growth potential of SIPs. In the words of legendary investor Warren Buffett, we don't have to be smarter than the rest, we have to be more disciplined than the rest. 5 important steps to diversify. Lastly, diversify, diversify and diversify. It is important to have a strategy in place for asset allocation that can help you diversify properly. Your portfolio should have a mix of these 5 investment styles. Quality, stocks that have and are likely to maintain high value. Secondly, value, undervalued stocks that may gain momentum in the future. Growth at a reasonable price, which is nothing but a blend of the 2 styles that I just mentioned, that is quality and value. This philosophy suggests investing in companies with potential for good earnings growth and are available at reasonable valuations. Mid and small caps. This is based on the evidence. Historically, mid and small cap companies have given better yields than large cap companies over the long run. And lastly, global. This is to provide geographical diversification to your portfolio. But why this strategy? Let me explain. If you look at it historically, such a plan has led to a solid long-term outperformance of 4% annually over the last 10 years when compared to the Nifty 50 Total Returns Index as on 29 July 2022. Moreover, there have been far lower declines during major market falls as compared to the Nifty 50 Total Returns Index and Nifty 500 Total Returns Index. Too much information, right? If you feel it's a lot to take in, do remember that you can never go wrong with an SIP. So start small and build your journey thereon. Hope this video helps you build a perfect portfolio in keeping with your financial goals. Thanks a lot for watching. For more such videos, keep watching Money Control.